Welcome to Financial Coffee Talk with Shane Amy and Shane Swearingen, your planning duo from Shane and Shane Financial.
And we are here with Shane Swearingen and Shane Amy, Shane and Shane Financial for our Financial Coffee Talk. And today, gentlemen, talking about some current events, some concerns on the minds of savers and investors, the developing situation with Silicon Valley Bank and the bank collapse. What do savers and investors really need to worry about here, Shane, Amy?
Yeah, so the short answer is, unless your money was there, not a whole lot. There's a difference between what's happening now and then when everybody sort of flashes back to 2007, 2008. So just to quickly break it down, in 2007 and 2008, that's what we call a credit crisis. Okay, so hey, we're going to lend out money to this family who we know has a slim to no chance of paying back this debt for their home. Hey, here's your combined income, and you should probably have a house, for $200,000, and we're going to give you this mortgage for a house for $800,000. And so everybody was in on it. Fannie Mae, Freddie Mac, they're all signing off on this A-rated stuff, and that was fraud. Like that was a man-made, disaster. This is a liquidity run. So you have credit on one hand, you have liquidity on the other. So basically, if you have a liquidity run, it's simply that, more people want their money than what the bank actually has on hand to give them. And that is due to really just mismanagement of the bank. It's probably not as bad as you think. It's not like, like we'll take that Silicon Valley Bank, which is, made the headlines. Hey, they're investing in, all these risky things. It's really not that. They were invested in, treasuries. They were just very long treasuries. So like 15 years, 20 years, 25 years, which is great because you get a little extra juice on those. But general rule of thumb is, the longer the duration of a bond, the more sensitive it is to interest. And, when you go from almost no interest to a whole lot of interest, pretty much overnight, that's where they really got caught. And so, you have to be careful, where you put your money. I know that people are, these regional banks, we should all put our money at these big giant banks. At the end of the day, in my opinion, I don't think that this is a systemic or a system-wide failure. I just think that there are a handful of banks, that are investing in, in industries that are new, cutting edge. That there's a lot of failure when you're trying to get that off the ground. And to be quite honest, they were poorly ran. I don't think that speaks for the banking sector in general. I just think it speaks to these handful of banks. I was reading on Bloomberg this morning. I think Credit Suisse is kind of next, and then the Deschutes Bank, and so there's going to be jitters, there's going to be emotions, but at the end of the day, your money's fine in whatever bank that you're going to choose to have it. Remember, the government has your back there as well with FDIC insurance.
And so for individual saver depositors with accounts below that FDIC insurance level, $250,000, or even a joint account for maybe a married couple, you've got 2 times that amount. Shane Swearingen, really not a lot to worry about there. However, you also have some opinion on whether or not keeping that much, or certainly more than that, would even be the wisest decision with money.
Sure. This isn't the first time that a bank has been mismanaged, as Mr. Amy has indicated. We could even go further back into the, early 90s. We lost over 1,500 banks and S&Ls. Today, we're talking about 2. So, it's a very different situation from back then, obviously, even moving on from 2007, 2008. But the circumstance is very unique. It's different in that, illiquidity forced people to make a run on a bank, and people saw that coming. Majority of the companies are tech-based companies in Silicon Valley. So it's a very unique situation. Investors should not be panicking, in our professional opinions. I'm not going to, speculate onto exactly what happened at that particular bank, but it seemed as if things were improperly managed. So for our clients, for our investors, if you have more than $250,000 at a bank, there's probably an underlying concern that we would have is we want to get that money moving for you. There are other instruments to provide safety and protection outside of FDIC insurance. Majority of our clients that do have assets with our institution on the investment side, banks operate a lot differently than, a brokerage firm per se. So there's not a whole lot to worry about, but it just comes back to the point of you have to be properly managing your assets. It would be prudent not to have 250,000 in a bank account. For a married couple, that's 500,000. So again, we got to get your money moving. We got to have proper balance, so to speak.
And back to you again, Shane Swearingen. It seems like the rate hikes of last year that the Fed conducted are actually a large part of the underlying problem that attributed to this. And now the Fed has stepped in not only to bail out the investors and depositors, but also said that they will probably slow or at a near end to the rate hikes. And the market in general has seemed to appreciate this news.
Yeah, absolutely. We appreciate the news. I'm sure a lot of investors do as well. We'll see how the markets react, but it just seems that, when any set of news comes out, the markets like to react up or down. So you just got to be careful to what you're paying attention to. There's always going to be a new monster. It was interest rates. Now it's, banks collapsing. So what's going to be next? We can't predict that, but it's going to be constant. All of the talking media heads are going to, put the worst and fearful news out there in front of you. Be careful from what you're taking in. But as you stated, Peter, interest rates, I think we're coming to an end. We'll see exactly what happens. The bank crisis, I believe, acted as another small rate increase. So hopefully we're coming to an end. Inflation is down to about, I think 5 to 5.5% year over year. So we still got some work to do, but it is a good sign for things to come.
And Shane, Amy, this is just yet another reason why plans need to not only be dynamic, but continue to be monitored and updated on a ongoing and regular basis. And maybe having that planner relationship allows you to continue to monitor the conditions in the market without having to constantly pay attention to the news headlines.
Yeah, well said. I spoke the last 2 nights. So today's Friday. So I spoke Wednesday and Thursday. And so there's like this theme of questions that I get. And this is one of them, which is why we're talking about it. The other thing is, what do you think? What's your outlook? Oh my gosh, what's happening? There's so much volatility. So, at the end of the day, for the remainder of this year, I do expect for it to be fairly bad. In other words, I think there's going to be a lot of volatility. I still think we have some stuff to go through in terms of an economy overall. I do think it's going to be choppy for the next 8 months. So hang in there. But remember, next year, that's an election year. And so, things won't be this way next year, so things are going to have to start working out a little bit better. And, the party that's always in power is going to make sure that, some things get fixed and we're on our way and they want to get reelected again. And so just, remember, this isn't a system failure in the banking. Yes, the rest of this year is going to be dramatic. We do expect for some pullbacks. I think you just, you stay the course. If you're, I don't want to use the word scared, but I mean, if you're, unsure of what direction you're heading, get with your financial professional, give us a call, someone you trust, and make sure that you have a plan. Because, to my partner's point, if you have a plan, when the market's up and the economy's great, hey, that's wonderful. When the market's down, the economy's bad, you know what, that's okay too. Find that balance as Shane said, and you'll be fine.
Well, if you would like to review, update your plan, get a plan put together, pick up the phone, give Shane and Shane Financial a call, 888-300-3811, 888-300-3811, or you can visit online and connect there, ShaneandShaneFinancial.com, ShaneandShaneFinancial.com. So Shane, Swear Engine, following up on Shane Amy's comment, are we on recession watch at this point in time?
I think it's tough to say. Everyone's definition of a recession is slightly different. GDP is still up. That's something that we look at, that we track on a yearly basis. Some indicators would point we're not. Some would. There's a lot of headwinds. I'll put it that way. There's a lot of headwinds that are stopping our country and economy from growing as fast as it should be. So to speak. But again, it's all about being properly diversified, being comfortable in your plan. And, if there's one thing we've learned, we talk about liquidity all the time for our clients. The more liquid you are, the more action you can take with the rest of your assets, or at least feel confident you don't have to react to what's happening around you if you have access to capital. And that's exactly what happened to SVB Bank. In California, they were illiquid. So they were forced to liquidate some of their assets and take a loss, which ultimately, resulted in what happened. So it's important for banks. It's important for our clients to be liquid at the same time.
Paying attention to the conditions as they develop. Shane and Shane Financial here as a resource for you, ladies and gentlemen. And if you would, again, like to get that plan put together, review, double check, and update a current plan, pick up the phone, give a call, 888-300-3811. That's 888-300-3811, or visit online, ShaneandShaneFinancial.com. ShaneandShaneFinancial.com. Here with another edition of Coffee Talk, bringing us up to speed on the latest developments on the Silicon Valley Bank and the banking system, and making sure that we stay updated with those current events. And gentlemen, we always appreciate the time that you give and the insight and guidance for proactive savers and investors.
Thanks, Peter.
Thanks, Peter.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fee-based financial planning and investment advisory services are offered through Truvestments Capital, LLC, an SEC-registered investment advisor.